Goals are proven to have an energizing role in life, and the higher the goal, the greater the effort you're likely to put in. By having investment goals, you're more likely to hold onto your better performing investments for longer, because your focus is on achieving your objectives rather than the gains or losses of individual investments. Welcome to the From Zero to Wealth channel. If you're new here, this channel provides you easy to understand information about wealth creation through personal finance and investing, teaching you what schools should have. And if you are returning, welcome back. In this video, we'll go over why goal-based investment is important, how to set up your investment goals, and how you can choose investments that align with your goals. Most of us have a number of goals to achieve, which may be short-term, medium-term, or long-term, but we never plan our finances according to them. Although there is a growing awareness about investing, we are often indifferent to the reason for which we invest. Investment is a long-term activity. It is important to make investment decisions after thorough planning and understanding of the investment options available in the market. Why is goal-based investment important? For several reasons. 1. It makes your vision clear about your future plans. Financial planning is about setting financial goals, which will make your long-term vision clear. You will be able to invest smoothly across different stages of life and in various instruments. For instance, if your vision is to own a villa in the next 10 years, your financial goal will comprise saving and investing in long-term mutual funds, which have low risk and high return. On the other hand, if you just want to make enough money to be able to go on an international vacation, then investing in short-term liquid funds will be ideal. 2. It helps you to create an investment strategy. With financial goals in place, you will be able to formulate an effective investment strategy. For a short-term goal, you will need to choose an aggressive investment plan. For long-term goals, which have a span of 5 to 7 years, you may choose a diversified growth option that will help you grow your wealth. 3. It keeps you motivated to achieve your investment goals. When you have your goals in place, you will be saving for a tangible outcome. When you attach an outcome to your savings, you will be motivated to save and work harder to attain your goals. For instance, if you plan to invest to be able to buy your first car within the next 2 years, your enthusiasm to save and invest will be high. 4. It lets you avoid debt. A goal-based investment will help you avoid debts. If you are working to achieve a goal, you will plan better, save more, and invest more. You will stop impulsive purchases, restrict yourself from being extravagant, and not take on debt which will have to be repaid in the near future. Remember, if you have a debt on you, there will be a monthly outflow and you will be required to repay the same on time. To begin setting your own goals, it's good to gain an understanding of the things you need to afford now and would like to afford in the future. For investors, factors such as income, age, and future outlook all influence motivations for investing. So step 1 is to define your goals. Some of the more common types of financial goals are retirement. People are continuously interested in saving enough money from formal employment to be able to call it quits forever. Emergency funding. Funding emergency reserves is another very popular goal. Ideally, an emergency fund is a pile of cash with 6 to 12 months of living expenses. Family planning. Starting a family is also a common goal that many people plan for from a financial perspective. Expenses might include the cost of setting up a nursery, arranging childcare, and buying child-related gear. College funding. This is another major long-term goal that many young families have. While there are grants and other forms of aid available to many students, parents are generally expected to cover a significant portion of education costs. If your children ultimately want a professional career, you'll need to plan for college costs well in advance. And life events. Some people save and invest money for big life events, such as a wedding or a lengthy vacation. Step 2 is figuring out a strategy based on your goals. Look for the best investment options and invest according to your risk appetite. There are 4 main investment objectives: growth, cash flow, lifestyle, and preservation. Let's look into growth first. People want to grow their money through investing. They want to increase it beyond the impact of inflation, so they increase the purchasing power over time. While this might seem obvious as an investment goal, growth is most likely to be an objective when the investor has a lengthy time horizon. As we constantly see, markets fluctuate in a random fashion. People with very short investment time horizons may want to focus on other priorities instead of putting too much money at risk. Cash flow is the bedrock of any sound financial plan. More cash flow means a greater ability to save, invest, and pay down debt. Optimizing for cash flow might include taking on a sidekick, investing in high dividend yielding stocks, and so on. Cash available generally means more flexibility, adaptability, and psychological safety. 3 things most of us are better off with than without. Lifestyle improvement or maintenance is another objective of investing. Some people are happy with the material goods they have, while others strive for bigger and better. The good news is that both are entirely acceptable. You might focus on covering your immediate expenses to fund larger goals down the line. Or you might spend more now to improve your lifestyle going forward. Beyond increasing their money to its highest point, people who are approaching or in retirement also focus on wealth preservation. Preservation can certainly be as important as growth, depending on a number of factors: your estimated time to retirement, your overall net worth, as well as your money mindset. Even if you have the ability to take additional risk with the hope of increasing your money even more, you might sleep better at night knowing you have a certain amount locked in. The last step is to set up an investing workflow. One of the best ways to achieve investing success is to set up a framework for action. Without specific goals and objectives, the workflow will be more difficult to implement. A written document can go a very long way in spurring action and creating a mental framework concerning money. Short-term goals might include reducing your debt load or starting an emergency fund, while longer-term goals might include retirement planning and/or college funding. Regardless of your specific goals, it's good practice to have them down on paper. Assign a timeline to your goals. Some funds are needed immediately, for example, if you are paying down high-interest credit card debt, and other funds are needed many decades in the future. This is completely normal, so give yourself time to prioritize those goals that are most important to you and those that will have the greatest positive impact on your net worth. With longer-term goals, such as retirement, it's imperative that you start sooner rather than later, even if it's with a small amount of money. The power of compound earnings will intensify over time, so by starting small today, you'll have money working in the background for years to come. By pinpointing when you'll need the money, you can figure out how much you need to save every year to ultimately achieve your funding goals. For retirement, the answer to this tends to be as much as possible. But for more finite goals, such as education planning, you can reverse engineer the amount you need to save if you start at the birth of a child or at another year in the future. When choosing investments that align with your goals, there are 2 factors to consider: risk and investment goals and asset allocation. A little side note before we continue with this video. If you'd like to begin investing and you want to learn and understand the basics of investing, check out the video The Basics of Investing, series part 1, where we explain how investing works, why people invest, the types and risk of investing, and more. just the very basics of investing that you should know before starting. We'll also put the link of the video in the description box. Let's dive a little deeper into the risk and investment goals. Instead of making investments based only on personal risk tolerance, it's also essential to consider the level of risk required to meet each goal. For example, a natural risk taker may have an investment goal that only requires a conservative investment strategy. If an investor's goal is to preserve capital in the short term, this would require a low-risk approach and, therefore, a more conservative investment strategy. A moderate strategy may suit goals requiring a higher balance of risk and return than a conservative strategy, depending on your risk tolerance. An aggressive approach can suit longer-term goals, where investors are willing to accept higher levels of risk for higher returns. When it comes to asset allocation, asset classes provide different benefits depending on the time frame and risk required to achieve each goal. For instance, if your goal were to buy a new car, you would have a short-term time horizon. Short-term investments usually provide lower returns but are highly liquid, and you can generally cash out your money within 3 to 12 months. It's considered safer to invest in asset classes that are almost risk-free, such as high-yield savings account, short-term bonds, and cash. For goals with a medium to long-term horizon, investors aren't planning to need the money invested straight away, so the focus shifts from protecting short-term capital to future wealth generation. The main benefit of longer-term investments is that returns can be much higher. They can also help to overcome investment obstacles by riding out peaks and drops in the market, providing more consistent returns over time. Asset classes such as shares, real estate, medium and long-term bonds, and commodities tend to be more volatile, so higher risk, or require longer investment terms and therefore better suited to longer-term goals. An effective way to approach asset allocation is to have a balanced mix of asset classes that match each longer-term goal's time horizon and risk tolerance. Because many asset classes are uncorrelated, having a combination of them can protect your portfolio from downturns in the market, a strategy called diversification. With diversification, your higher performing investments should ideally outweigh your lower performing investments by spreading risk across multiple uncorrelated investments and asset classes. Setting investment goals is a personal investment in many ways, but achieving them can mean financial freedom in the future. Goals are moving targets, so the key to goal-based investing is to stay focused on the overall outcome while adjusting investment strategies along the way. We hope you find this video helpful. If you enjoyed this video, don't forget to like the video, subscribe to the channel for more videos, and turn your bell notification on to get notified when new videos are uploaded. Thank you for watching, and we'll see you in the next video.